And welcome to the VSA Capital Tech and Transitional Energy Podcast. It's Thursday, September the 15th. Hi, Phil. How are you?
Hey, very good. Thank you very much, Andrew. Yep, I'm good form.
You haven't gone and joined the queues to see the Queen lying in the whatever it's the Caliphate or whatever is it? I think it's called. Long queue it is, mind.
Yeah, quite incredible the numbers of people that are coming into London for that. So yeah, quite an event.
Anyway, look, we should probably crack on. There's been quite a lot of sort of news items this week. I think we need to sort of really go straight into rather than the usual sort of boring, dribbling preamble that I often give. And actually, I think one of the big ones, because I think it puts it all into context to a certain extent, was the CEO of ITM Power resigning. What's your take on that?
Graham Cooley. Yeah, I mean, if they're developing new electrolyzer technology, they're building a plant, they're trying to get contracts. It's very innovative technology. And with it comes lots of complexities and capital required. They raised funds back in, I think, November, about £250 million in funds. And the share price, has gone down considerably since then. And they made an announcement that it was full year results. It's full year and saying that, one of the main projects was suffering delays and they'd learned lots of technical lessons along the way. So, there've been quite a few difficulties in developing this new tech, which could be a very exciting market. Of course, it's producing hydrogen using electrolysis in their machines. So yeah, very disappointing.
I mean, the stock. I mean, I think this is the point: is that if you look at what's happening in the transitional energy space, be it ITM with hydrogen, our favourite Invinity with vanadium, and various the others, it's a sector problem really, rather than maybe a stock problem. I mean, ITM peaked, I think, at about £7, and it's now down at just over £1. Now that's a terrible fall. It's actually off over 70% this year. So when people sometimes look at some of these stocks and go, oh God, isn't it a disaster? Actually part of the problem is simply that the market is out of favour big time with these stocks. Now, no one likes to catch a falling knife. Well, not many people do anyway. It can be very dangerous. I'm talking metaphorically here as well. But clearly at some stage, some of these companies, and ICM Power is an example, I think, it's got a good balance sheet. It's got some very good partners on the corporate structure. They will actually get oversold, having been actually in hindsight overbought. I don't know quite where the bottom is. Clearly, when you see a CEO go, one worries a lot. But maybe the new one coming in actually will put it on a better path and it's time to buy it. The jury is clearly out at the moment, but I think that's the point really, is that it's a sector problem. There's a lot of money that went flying into it is somewhat flying out. Now, also, of course, short term, there's this perception that because of the Ukraine war and the gas crisis, everybody's suddenly going, oh, hang on a second, let's U-turn. We don't want renewables after all. We want and the transition energy. Let's go back to coal and things like that. But let's be honest, the direction of travel longer term is to renewable energy and is to the transitional energy revolution. This is just a short-term U-turn, not a long-term one. So, the arguments that were put forward 2 years ago to get people to invest in these stocks at the much higher levels actually do still remain in place today. It's just the macro environment has changed, but it will be a short-term change. I think you'd agree with me, wouldn't you?
Yeah, I would. And if we, read, I'm going to go through some of the results on renewable energy related funds and what they're saying, and that clearly comes out. I think one of the challenges is that we've been looking at some very innovative technology which has got huge market potential, and that takes time to develop as well. But looking to overall renewable energy, I mean, I don't know, did you see Greencoat Renewables? Tickers are a GRPG. It's about 1.4 billion market cap. They had their interim results. And they, initially this was wind farm assets in Ireland, and they've they've expanded into Europe. It's wind and solar assets that they've got. And they reported, their investments as wind and solar assets generated 1,127 gigawatt hours of electricity in the first half this year, compared with 745 gigawatt hours in the prior period, generating cash of 92.1 million euros net cash generation, and their net assets increased to 1.2 2 billion euros versus 0.7 billion euros in the prior period, because they're investing in these renewable generating assets, which are generating very clearly a lot of cash, and their shares are up 11% year to date, and it pays just under a 5% div. So that was
Well, of course, actually, Phil, they could be up an awful lot more, but the fact that, of course, people are sitting there thinking, hang on a second, they are generating extraordinarily high profits because of the way electricity is priced, that we know is absurd, because it's basically the gas price. And of course, people are worried that those rules are going to change. And so actually some of the stock performances that you'd think would be absolutely stunning maybe haven't been quite as stunning as they could have been because of concerns of that.
That's you're absolutely right. And but nonetheless, I think what I'm trying to say here is that the amount of power, the sheer amount of power now that's being generated is overall increasing. The whole transitional energy story is far from gone away, and investment, capital investment is happening in infrastructure. But here. I mean, Downing Renewable Infrastructure Trust, the ticker is DORE. I mean, that had interim results as well, and it's a kind of similar story. Their net assets increased to about 116p. They were up 12.4 pence, and that was primarily by accretive acquisitions, i.e., acquiring assets, increased power prices, and inflation. So they saw a high NAV return. But again, it's just that they're also investing quite strongly in their in their portfolio. So but you're right. Two stories. Investment is going on, but you are correct that let's see how long these power prices do hold.
Well, another one, it's a small one, but involved in power, is U Group, and they had a trading update where they said that adjusted EBITDA on operational cash flow and net profitability has significantly exceeded management expectations. And the board expects a strong performance to continue for the remainder of the financial year. I don't know if you saw that. It's quite a small one, quite niche. But that shows what's going on potentially in the power market. Some people are making extraordinary profits.
Yeah, that's for sure. Another company reported this week was Smart Metering Systems. Ticker is SMS, 1.1 billion market cap. They had interims. Their shares are down about 8% this year, but they are trading on a multiple of 9 times revenue. My words, and a P of 60 times. Good grief. But what's quite interesting is some of the dynamics of what's happening within their business. And they are a big installer of smart meters, provider of energy data, but they install EV networks, which I didn't know, and they also own and operate grid storage assets, and total if they've got assets in pipeline of 760 megawatts. So they were reporting on the growth in the smart meter installations. Again, it's a fundamental change in the energy markets. But what was quite interesting for me was that the growth in their revenue was up 20% to 63 million, and their profit before tax was up 22% to 6 million pounds. And it's sat in cash of, I just want to do the fundraise, but its cash is up from 5.6 to 38.6, so maybe it raised some investment as well. But it's an interesting way to potentially play the sector for investors.
Well, it is, but actually, I did read them, but I probably scrolled down a bit further than you. Because I was looking at what they were saying about the price of lithium-ion batteries. And basically they were saying that the cost of developing these things is going up because, of course, we all know that lithium is becoming scarce. Lithium price is staying very strong. There are other inflationary costs, and there are other logistical costs. And they did point out that it's a problem that they are potentially facing.
Yeah. Oh, I do get.
I mean, they actually say Longer term, we anticipate that inflation in battery and electrical equipment costs will increase the development costs for the sites that we are yet to enter construction on or are currently under exclusivity. That is a little bit of a warning there about the price of lithium-ion batteries.
Yeah, isn't it just? And of course, you talk a lot from our, from the mining side of our business about lithium requirements and the market demands and how difficult it's going to get in terms of the scale of the lithium that's going to be required and what that could do to pricing. Yeah, interesting they came out with that.
Yeah, now we had results from a couple of your favourites you better mention, which is Carrero and Ricardo.
Yeah, do you know what? I've not got those in front of me, but I certainly did.
Sorry.
Thank you very much. That's all right.
I thought you would because you like them so much. I mean, Carrero, what they announced, they were interims, record levels. And the board remains very confident in meeting expectations. So it's all going pretty well, I would say, at Carrero.
Yeah, the profit ticked up, the bottom line, which was good to see. But yeah, no, that was a decent set of numbers, I thought. Yeah. Cyber security. Yep, good space.
No, I'm sorry to catch you out there. And Ricardo had their prelims. Again, actually, these were pretty good results. I mean, it was in line with expectations. The underlying profit was up 46%, so they were obviously looking pretty good. But on the outlook, they continue to see strong momentum, underpinned by environmental and energy transition needs. They got a strong order book, number of high-value contracts. So they're confident they'll deliver on their expectations despite the uncertainty in the short term. So yeah, look, I thought that was a pretty good set of results as well, and they're two of your little favourites.
Well, Ricardo. I was reading through the Ricardo ones. I think also they're seeing quite a bit of momentum because Ricardo, has always been strong in automotive, but I think that they're seeing increasing activity in vehicle electrifications playing to their favour as well. That automotive expertise that they've got and years of it. Yeah, but that was a good set of numbers.
Yeah, sorry, I'd leave it to you to go through the results. I don't want to catch you out again.
Oh, but I did read them though. Now, quickly flipping back to cyber security, Carrero Space. You might have seen that Cape Technologies, KAPE, 960 million market cap, and these shares have suffered. They've been down 38% year to date. Nonetheless, it is digital security, privacy software. And they've announced that they've raised $220 million, 188 million in the UK market. Today that was announced, and I think that is to fund, particularly to fund acquisition activity. So market appetite there.
Yeah, it was a really good raise, actually. I mean, and funny enough, we're all moaning at the moment about a lack of liquidity in the market, and there is a lack of liquidity in the market, but actually there have been one or two fundraisers coming through that have been really quite successful. So clearly there is a little bit of a glimmer of hope after all.
Yeah, no. I thought, that was quite a response to that fundraise. Sticking with with tech, HG Capital Trust, 1.8 billion market cap. HGT is the ticker. They had interims. This is a really interesting way to play tech investment. Their shares are, I think, down about 11% year to date, so holding well because HG Capital have they invest specifically in software and services and larger private software and services companies at that. Their NAV of 2 billion increased by 1.8% during the period, and we've got to remember that there'll be some marking, I think, public company valuations here in the tech sector, and of course they have suffered, but overall their investment values went up, which is very good. And they said that across their top 20 investments, they've got 46 investments in total, and they said across their top 20, the revenue and EBITDA growth was 31% and 26% respectively in the last 12 months, so these are really good businesses, and I think HG is one that's well worth a bit more deeper examination, as they say.
Actually, that is very good performance, isn't it? I mean, we quite often do talk about some of the funds that are around in the technology space and the biotechnology space, because they are, for your average investor, it's quite difficult to invest, on just one stock because there is so much risk. Going into some of these funds that have some really smart people running them is, in my view, a very good way for what I describe as your SIP or your pension or your whatever, which is why we do talk about them quite a lot. Although you could say, well, but they're trading at a discount to NAV and this sort of thing. Yeah, sure, but sometimes they shouldn't, in my view. Actually, there should be a premium for having a good fund manager. But that discount probably can get worse, can get better, but it's a very good way of getting a wide range of exposure.
Yeah, absolutely. And if you look at this, the performance of their shares versus the wider sector, it's outperformed. I mean, the Nasdaq. I was looking at the Nasdaq, and it's down 25% year to date. But I tell you what's interesting about the Nasdaq is, just for a sense of perspective, it's down about 12,000 at the moment. It was 6,000 at the end of 2018. So even despite recent falls, it's doubled since then. So just a sense
Good stat.
Yeah, there you go. Sense of perspective. So yes, that's HG Capital. And one that we have commented on before and did very well through COVID is Computer Center. Tickers CCC, 3 Cs, 2.7 billion market cap. Their shares are down 25% year to date, and they've just had their interims. The business is 193 million cash, so it's well funded, but they've got 3 core lines of business. So technology sourcing, so sourcing all the tech you need for your business, all the hardware, professional services, so that'd be like things like consultancy, tech consultancy, and then managed services, where you outsource your cloud services and stuff. So all the IT things that businesses need. And they had, as I say, they reported their interim results, and they did very well through COVID. When companies were picking up lots of tech, and they overall, if I've got this read, it's only small print. The overall revenues, technology sourcing, the main bit of the business was up by 25%. So that was good. Services revenue was up 6.5%, 700 million, and overall income was up by about 20% to £4 billion. But looking at the profit line, profit was down 6% to 112 million pounds. So, so sales up, but profits down, and they pointed out that they had a very large volume customer that they had serviced, which was on a lower margin. So that had some impact on the profits. But I thought what was quite interesting I got out of this was that they, overall they're still seeing strong momentum in the client base, which is very interesting. Corporate's still spending on IT, but they've also seen a material change in the supply chain, and this is tech, which tech hardware in particular, where there have been all sorts of supply issues, particularly in the semiconductor side. So they're seeing an easing there. So that was very interesting to see.
I think that is what we're seeing. We're seeing an easing in the supply chains. We're seeing actually quite a rapid decrease now in freight rates. The bit that I think is going to get difficult is that at some stage, even the corporate customers are going to start cutting back on their capex, because it is going to get tough.
Yeah, and they were saying here that they're where are we? North America. So they're very strong in the UK, and they had seen some of the activity in the UK slowed down. Part is because Windows 10 related systems have been all upgraded and installed, so that sort of cycle's ended. Where they were seeing growth in particular, they said, was in North America, and it was hyperscale data center customers. So this is real, cloud services stuff that's still very much still driving it. But interesting news from them, and to see the shifting dynamics in the space. But yes, you are right that inevitably, if the economies continue to weaken, capex could get cut. There we go.
All right. What next?
Smaller techie one. Eleco. That's ELECO is the company name. ELCO is the ticker, and they are 60 million market cap. They had interims. I know I've met this company before. They do software for the construction industry, and their customers are UK, Sweden, and Germany and Netherlands. And their software, from recollection, it's all very much design related in construction, things like interior fit out, and they can simulate what interiors look like, element of facilities management stuff. Anyway, look, it's construction industry related. Let's see how that industry grows. But they said they got a positive performance in the first half, growth in subscription revenues. They're converting all their business over to SaaS from licenses. Seeing new customer growth in the US and demand in Sweden. So reasonable set of results there. The revenue was fairly, more or less flat. Profits slightly down. So yeah, maybe some work to do for them, but at least it's got cash in the balance sheet.
Now, have you got any more results on the tech side, or
No, I'm done.
There's one other thing on the tech side I got very excited about this week, didn't I, Phil? But I still am excited. I've been chasing it. Then I said, don't worry, I've got it in hand.
You did. Go on, Andrew.
Anyway, we are going to do some more research on this, but I got very excited this week. 3 of my favorite things all sort of came together. And that is, we've been looking at a private company based up in Cambridge, also has an office in Boston, called Niobolt. And they make ultra fast charging sort of batteries and things by using tungsten, which of course is one of my favorite commodities. And more importantly than that, they've just done a big funding round, and the funding round was actually led basically by one of the big subsidiaries of Masan, which is a huge Vietnamese company. And I love Vietnam too. So I've been getting very excited about, super fast charging batteries, tungsten and Vietnam all put together. And this is just right up my street. So I am uber excited about Niobolt. And we will be doing more research into it, I'm going to assure you, and bring you more interest, more knowledge if we can about what's going on here. But I am uber excited. But we also want to just touch on the we do sometimes call this tech, trans and brands.
Yeah.
We might need a third speaker to come onto the podcast to be brands, if you're tech and you're trans and I'm tech, brother. Whichever way around. But we did have a bit of news out in 2 of the brand stocks that we follow, didn't we, Phil? So we got the Hut Group today had a warning, which I mean has just sent that share price. It can't get much lower, but it really is starting to prove to be, the IPO flop of I don't know what. Quite extraordinary, really, isn't it?
Yeah.
I don't know if you've got any additional comment on that, other than the fact that to have that warning this morning is just, well, as I say, extraordinary.
Yeah, I mean, they said that their profit, you're always looking at gross profits on companies because it's always a reflection of pricing power that they have, as well as their cost structure. But they said the gross margin have fallen from 46.5% down to 42%. And they said primarily reflects the strategy to partially shield consumers from adverse macroeconomic conditions.
I mean, this company, correct me if I'm wrong, I think it was floated, wasn't it, at about I think I'm correct, about 600p.
Yeah, that's it.
Peaked at about 800p. It's now down at 40p.
Oh my God.
And it's just, anyway, that was a bad brand. Actually, I think on the good side, one of our clients, Samarkand, announced a funding where they brought in Smollen, which was already a strategic shareholder, but they're putting more money in. The directors are putting in money. And what they've done is, so that's enough money actually to see them through, hopefully to cash flow neutrality and money-wise never get right out the door, but, puts everyone's mind at rest. And then, of course, they're holding an open offer, aren't they, for another 1.5 million if others want to follow in at the same price. So they're not just sort of saying, look, we're taking this money and bad luck, guys, they get the cheap stock, you don't. And actually, I've had some really positive feedback from a few major institutions who had got a bit worried about the performance of the company, which wasn't really their fault because China was the macro element that was causing all the problems. And actually, they rang me and said, you know what, Andrew, that's really good. You've got the money from elsewhere, so we don't have to stomp up. But the fact you've given me the option to do it, you know what, I think I'm going to put money in. So we won't know until the close of the open offer next week on the 20th. but I'm quite confident that actually a bit more money will come in. And I think that the guys have, they've done exactly what they said they'd do on the tin when they floated. It's just been unfortunate with China, but China is starting to pick up again, actually, in terms of people buying goods. They're doing very well on their brand side. And actually, of course, who knows what will happen after mid-October and the 20th Party Conference has been held. It could be all changed. You never know.
Yeah, absolutely. Yeah, no, they reported that the full-year results very recently. Samarkand, ticker's SMK, it is a corporate client of ours, but they reported full year, and they said that going into the first quarter, so the year ends March, so the first quarter ending June, they've actually had very strong trading. So things already picking up for them. So that was very positive. Good, interesting to hear.
Okay, you got anything else?
No, that is it on what has been a full week, but hopefully we've condensed it all pretty well and given some ideas in there. So yeah, look forward to more next week.
Hang on, Phil. Tomorrow is still part of the week. You're not on a 4-day week yet.
Yeah, I know, Andrew. I understand that, but I hope you've seen that Citigroup are opening an office in Malaga for their bankers.
I did see that, right? But Phil, that is for their new trainees, not experienced analysts like you. And I did wonder whether any of the staff are going to say, "Hey, Andrew, when are we going to be opening an office in Malaga?" My parents used to have a villa in Mijas, which is very close to Malaga. I used to go out there every year. I loved it. So it's quite tempting. But I think, as you know, if we're going to have an office anywhere else, it's going to be Cornwall. The Cornish office. So anyway, I think we've sort of squeezed the pips out of you, Phil, this week and got as much as we can. So on that note, as I always say, look, if anybody's got any comments on what we've got to say, or anybody wants us to talk about anything, we're always happy to accept a challenge. If anybody wants to sponsor or bribe us, we're always open to all of these sort of things. Do get in touch with us. We love to hear from people, but we'll speak to you all again next week.
Brilliant. Look forward to that, Andrew.